opinion. We do have with us Nilesh Shetty, who's joining in, portfolio manager at Quantum Advisors. Good afternoon, Nilesh. Thank you for joining in. All the opinion that we get so far talks about how India is the brightest spot in the world right now, but that is also the most expensive in the world right now. How do you navigate through this, and what is it that you're doing in the markets?
Yeah, we agree with that. India has always been expensive. That is not a surprise. But it looks like it relative to the earnings cycle, the valuations are much above normal right now, especially in the mid-cap and small-cap space. No matter what earnings growth you want to peg there, I think valuations have moved far away from fundamentals there. We remain stock-specific, and there are pockets of opportunity. I think for us, incrementally, we see more of our capital being deployed in private sector banks, including on the savings side. So we have deployed capital on the insurance side of savings, AMCs, and broking companies. So that is where we found opportunities. But apart from that, generally cash levels in the portfolio have been inching higher as we've been trimming a lot of our other positions in the portfolio.
Okay. Nilesh, hi, welcome to the show. We do have TCS, which will be reporting numbers today. What is your sense in terms of what we can expect when it comes to revenue growth, margins, which is expected to be impacted on account of the wage hike, as well as commentary, especially on demand as well as artificial intelligence?
Yeah, I will not be able to comment on individual stocks, but IT is one of the few places where valuations are not extremely expensive. They're not relatively cheap, but within the context of where we are in the market, it is one of the few places that warrant allocation of capital. Wage hike generally is known. It is not something which every Q1 number is a wage hike quarter for all IT companies. So it's not a surprise as such for the market. But what most people are looking at is, most of these companies have picked up large orders, and the order book remains very healthy, which is not translated into revenue as clients keep deferring spends. And most people are waiting to see signs of that order book getting translated to revenue, which may see a pickup in valuations for these companies. AI, we are still trying to figure out how it impacts. There is a mixed opinion whether it's an opportunity or a threat. But historically, most of these disruptions in technology have been opportunities for Indian IT services companies to expand their share of wallet from the customer. It may not be that different this time as well, but we'll wait and see. As of now, we sort of sitting on the fence on the disruption that is coming.
Could you tell us what your allocation is right now, what your positioning is, underweight, overweight, equal weight, what sectors, and what are you incrementally doing in the market?
So the portfolio is built bottom up, and the sector allocation is an end reflection of that. But we have about 40% in BFSI, including large private sector banks, insurance companies, and a broking company, and asset management companies. We have zero allocation to consumer staples. They are getting interesting for us, given the underperformance that has happened over the last 3 years. We have zero allocation to capital goods and infrastructure space. That is where we see the maximum froth in valuation. They remind us of valuations that we saw in 2006-07 for these companies without the same kind of earnings traction, which tells us that the valuations are far above where they should be. And we've essentially trimmed our allocation in auto, where we had a large allocation a year ago, but we probably halved our allocation now as valuations have become expensive.
So where are you deploying this money that you're getting? Because you have zero exposure to staples, 40% to BFSI, a little on IT, like you said, and then you have a bunch of others. Auto, for instance, you halved your allocation out there. So what exactly are you looking at? Because even cap goods is something that you're finding very expensive.
Yeah, portfolio is sort of built with a 5-year view, so we have to be patient. Opportunities will come. Like I said, there are pockets where underperformance sort of has emerged over the last 3 years, including consumer staples, including consumer durables, which were growth favorites till, say, 3 years ago. They were the capital goods of the previous bull cycle. And given the valuations, earnings have disappointed. And so we expect that disappointment to continue. And at some point, opportunity might present itself for us to add some of these names to our portfolio.
So what's the cash that you're sitting on right now, and how does that compare to your historic cash levels?
So the cash today is about 15%. Our long-term average has been about 10%, but it has increased over the last 1 year. It has moved up.
Okay. All right. Well, your cash has moved up from 10% to 15%. You did mention autos. You've reduced your reduced your exposure there. You know, autos have been in focus on account of those SUV price cuts which have taken place. M&M has said that it's a part of their annual plan as well. But are you fearing maybe a contraction in demand, softness in demand when it comes to the auto space?
I mean, we try to model long-term growth in demand based on penetration levels, and there could be interim cycles where demand is higher or lower than that. But the worry was valuations. The valuations for us, based on the earnings growth that we were forecasting, were trading above where they should be. And there has been, most of them have doubled over the last 1 year. And earnings growth has been in the range of 25-30%, which has expanded price to earnings multiples quite materially in that bucket. So it's purely a valuation number, not necessarily we have a major view on earnings disappointment in that space.
Okay, so where exactly are valuations looking comfortable for you at this point?
Like I said, the 40% allocation remains in BFSI, which includes private sector banks, includes insurance companies, an asset management company that we picked up last year. And then incrementally, we are sort of observing the consumer durables and consumer staple space closely, which, like I said, is been underperforming for the last 3 years now, and still not cheap enough. We picked up one company there, which has done well for us, but it's a space where I expect more names to come through over the next 12 months.
Okay.
Is your portfolio market cap agnostic? What are you looking at in terms of when you say bottom up? Are some mid-cap opportunities attractive, or is it just the large caps that you're looking at?
It is a market cap agnostic, but we have a liquidity filter given the size of the portfolio. We need at least $1 million a day daily trading volume. And because of that, there is a large cap tilt in the portfolio. But if a liquid mid-cap company which meets a corporate governance norms, because we run a integrity screen on corporate governance for most of these companies, if they meet these two criteria and then meet our valuation criteria, we are happy to add them to the portfolio.
So what are you, so based on your criteria, you know, and the filters that you have, what is your exposure within the broader markets? Which are the sectors that you probably lean towards, or is it more stock specific, story specific?
It is completely stock specific. The end sector rates are just the outcome of individual stocks that we picked up at different points in time. But we don't have a view as such saying that this is the sector we need to increase weight at the moment. So if tomorrow a capital good company meets our filters and comes at a valuation that we are comfortable, despite the view on the overall sector that looks expensive, we are happy to add it to the portfolio.
So what would some of your recent additions be?
So like I said, the most sort of recent addition has been a private sector bank, which we picked up. I may not be able to disclose the names. And before that, there was a consumer durable company, which was sold off quite materially, which we added. That has done really well for us. It's actually virtually doubled from the price that we picked it up in the last 1 year. And then this bank remains a place of interest. And there are other sort of financials that we're tracking right now, where we think more names could come through.
Is this the large private sector bank that everyone keeps talking about, or is it something in the mid or not so small cap space sort of thing?
Top three, one of the top three private sector banks, not the largest, that we already had in the portfolio.
Got it.
Okay. All right. We're going to leave it on that note. Nilesh, thanks very much for joining in and speaking with us. And we'll touch base with you as and when, earnings season progresses. Thanks very much for joining in. We'll take a short break, but a quick programming note. Will the RBI cut rates this year? Is the Reserve Bank of India worried about a bubble in the stock market? Is India poised for a GDP upgrade? Coming up later in the day, a CNBC-TV18 mega exclusive, the definitive RBI governor interview only on India's most watched business news channel. Stay tuned.